Hello everyone, welcome back. So here I am going to explain about the various types of formulas we will use under the break-even analysis. Let us see the formulas one by one what we will use under break-even analysis. Formula we will use in the break-even analysis is determination of break-even point. As we know that break-even point is a situation where the company's total cost is equals to total revenue. That means there will be no profit and no loss situation for the company. So how we'll go for determining the break-even point? So break-even point will be determined in units as well as in sales value. So the formula for break-even point in units is fixed cost divided by contribution per unit. Means whatever the total fixed cost will be having, if fixed cost is divided with the contribution per unit, you will get the break even point in units. If the contribution is not given directly in the problem, so we can use alternative formula where the fixed cost is divided by selling price per unit minus variable cost per unit. Means contribution is equals to selling price per unit minus variable cost per unit. So by using this formula we can go for calculating the break even point in terms of units, that is number of units required to reach the break even point. And next we are having the second formula, that is break even point in sales value. So here under break even point in units we are calculating number of units. So here we will go for calculating the total value, what is the value required for the break even point. So now the formula is fixed cost divided by contribution per unit into selling price per unit. Means whatever the units we are calculating here, that should be multiplied with the selling price per unit. Then you will get the break even point in sales value. And or we can also use another formula is fixed cost divided by total contribution into total sales. So this is also now the formula where we'll go for using it for the calculation for the break even point in terms of sales value. And one more formula is fixed cost into sales divided by sales minus variable cost. So all these three formulas will be used for the calculation of break even point in sales value. So depending upon the information provided in the problem, we have to go for choosing the formula, which formula is suitable for our problem. So if in the problem, if they are given fixed cost, contribution and selling price per unit, then we can utilize this one. If they are not given selling price and they are given total sales, then we can utilize this formula. Like that, depending upon the information provided in the problem, we have to go for choosing which formula is suitable for calculating break even point. And in some cases in problems they will not directly go for providing the contribution per unit. In such cases the contribution per unit will be calculated by selling price per unit minus variable cost per unit. If contribution is not given, these two informations will be provided in the problem, that is selling price per unit and variable cost per unit will be given in the problem. So with these two informations you can go for calculating the contribution per unit. And the next formula is units to earn a desired profit. Means if the company is expecting some profit to earn in the future, so then how many units to be produced to earn the expected or desired profit. So the formula is fixed cost plus desired profit divided by contribution per unit. So whatever the fixed cost you are having, for fixed cost you should go for adding up of whatever the profit you are expecting. So that will be divided with the contribution per unit. Then you will get the total number of units required to earn the desired profit. And the next one is sales to earn desired profit. Means what is the sales we have to made for the getting up of our expected profit or desired profit. So fixed cost plus desired profit divided by PV ratio. PV ratio stands for profit volume ratio. So these two formulas will be used when the company is expecting some profit in the future. For that, what is the number of units to be produced and what is the number of sales to be made to get the desired profit. In such cases, these two formulas will be used. And the next formula is profit volume ratio, that is we can shortly will call it as a PV ratio. So PV ratio, the formula is contribution by sales. So in the problem, if they are not directly given the contribution, then we can utilize this formula, that is sales minus variable cost will give you the contribution. So sales minus variable cost divided by sales, you will get the profit volume ratio. Another formula is fixed cost plus profit divided by sales. So whatever the fixed cost you are having and what is the profit you are having, add both the things and divide with the sales, you will get the profit volume ratio. These are the formulas used for the calculation of profit volume ratio. And the next one is margin of safety. So margin of safety, the formula is profit divided by PV ratio. So whatever the profit you are having, so to calculate margin of safety, first you should go for calculating PV ratio. So then you should go for having the profit divided by PV ratio, then you will get the margin of safety. Or in cases if the information is not given of profit and they are not given any information to calculate PV ratio, in such cases we will use the formula actual sales minus break even sales to calculate the margin of safety. So actual sales indicates the sales amount which is given in the problem. Break even sales, so this indicates whatever the sales value we have calculated in break even point in sales value. So actual sales given in the problem minus break even sales which we have calculated, then you will get the margin of safety. Again, if the margin of safety, if you want to express in terms of percentages, then the formula is margin of safety divided by total sales. Whatever the margin of safety you are calculating here, so that should be divided with the total sales value, and if you multiply with 100, you can express margin of safety in terms of percentages. And again we are having one more formula for the profit volume ratio, that is change in contribution and change in sales. So this formula will be applicable when you are calculating PV ratio for more than one period or for more than 1 year. So in such cases this formula will be useful. What is the change in contribution between 2 years and what is the change in sales between 2 time periods? So that is by using that we can calculate PV ratio. Or one more formula is change in profit between 2 periods, change in sales in 2 periods. This is also one of the formula we will go for using for calculating PV ratio. So all these are the various formulas which we will use under the break-even analysis for knowing various aspects related to the business organization.